advisors, I'm super excited to introduce you to Elements in Real Life. This is a series of videos we're putting together to help you better understand how to do financial planning with Elements. Each week, Elements advisors will take real client questions and show you how they use the vital signs to provide real advice. So check it out, and of course, don't forget to like and subscribe.
Hey, I'm Scott Frank with Stone Steps Financial.
Hey, I'm Colton with Out of the Office Planning.
Yeah, and we're here to look at a scorecard today.
Yeah, should be fun. I'm looking forward to it.
And the question I'm hoping you can help with, Colton, is have a client who more recently has always been interested in real estate. Has they're a young family, young by my standards, right? They're like in their late 30s, early 40s, have a little child that's under a couple years old. One of the spouses works for a corporate job, doing like corporate, salary bonus and stock comp. The other spouse is starting their own company, so they're kind of in the process of being entrepreneurial and growing income, but don't have a tremendous amount of income from that. And then they have a primary residence, and they have one rental property. And they're always interested in buying more rental properties.
Is it just single family that they have currently?
Single family, yep. Single family rental property, yep. And they're just interested in growing and scaling that side of their balance sheet. But let's just dive in and take a look at their scorecard and see what you think.
All
right. So here's the scorecard for now. And now I'm just going to call out what these tiles do for us, and then you can please walk us through what you're seeing. The top tiles, when you're looking at this, are really telling us about risk. So what risks are the clients taking? They have a good amount of equity, which makes sense because they're young, in my opinion. And insurance, we don't have all their insurances updated. I promise you they have some life insurance, but it doesn't show, but I'll make sure it's added for next time.
Okay, that was going to be something I pounced on first.
Yeah, you're going to get life insurance right away. And they do have an estate plan as well. The next line is really, what are they doing with their income? So you can see their savings, spending, have debt payments, and have taxes. And then the bottom row, we have liquid term, qualified term, real estate term, business term, and total term. And all of those are just taking the year of whatever they have as an asset and dividing it by a year of expenses. So that's really what this is doing for the people who, if you haven't looked at a scorecard before. Colton, what do you see when you see this scorecard?
Yeah. I mean, the first thing that was going to jump out or did jump out was the insurance, of course, which you already, you hit on part of that. But I'd still want to verify, the disability insurance, if that's in play.
100%.
Liability insurance, especially, for the household, and with them being a business owner, if that's, depending on the business, might be important.
Yeah.
Cash flow, let's see, we're sitting at, let me do some quick math here. We're missing a little bit, looks like.
Yep. Missing about 4%. We don't know where it's going.
Yeah, but overall, really, man, the cash flow is not too bad.
No, it looks pretty good, right?
Yeah, savings is, I'd say healthy, especially is that going to continue, I guess, with the business starting?
That will. So that's actually with the business in full effort, growing and scaling. That's just from the other income. Okay,
nice. Yeah, that's healthy. Burn rate's healthy. Debt rate is, still falls in the healthy range, I think. It's not too bad. I think to answer their question on the real estate and adding another property, I would be concerned given their liquid term, especially.
Yeah, exactly.
Their liquidity only having about 3 months or so, give or take.
Right, 3 or 4 months, exactly. 4 months.
Yeah. And having the business, I'm assuming some of that liquid term might be the business account as well.
A little bit. Yeah. You're nailing it the same. This is exactly what I showed them as well. And for you advisors at home, when we look at, can you grow and scale an asset or buy and build in another asset, we want to look at that liquid term and go, hey, how long can you sustain yourselves if everything goes, you don't have renters, you don't have any income. And right now they're really they're playing it kind of tight. So that was exactly what I let them know. I'm like, hey, I want you to own more real estate in your future, but I really want to see you grow your liquid term first to really have a margin of safety so you can go grow into that.
Yeah, yeah, for sure. Because I don't know about you, but I'd almost want to shoot for at least a 1 in that liquid term
Probably
before.
like a 2, right?
Yeah,
Because I want a
before
1
thinking
for them
real
just for safety with having an entrepreneur, and
Mhm.
the other spouse is in a role that's kind of higher executive level
Mhm.
pay. And so sometimes those roles are easy to come by and sometimes they're not. So you
Yeah,
don't necessarily want to settle. So you want to have more runway to have time to go find the next thing.
yeah, yeah, for sure. Especially, is it tech or is it
This is more consumer product goods,
okay?
but like similar styles of pay and
Yeah,
stuff.
I only ask because with all the tech layoffs we've seen, I could add to the concern there. Um,
Absolutely.
yeah, I would definitely. I think if they want to do the real estate, they bump that liquid term up first. I'm curious, is the savings rate all going towards qualified, or is some of that going towards liquid?
Currently, it was all going towards qualified
Mm-hmm.
to drive down their tax base.
Mm-hmm.
But that's exactly the conversation we were having, was the benefit of building out more of the taxable assets and saving
Mm-hmm.
rather than just maxing out retirement assets.
Yeah,
Yeah.
I think probably worth sacrificing a little bit of the tax benefit
For safety, right? Like isn't
the
it
comfort.
amazing how
Yeah.
that's what I love about the scorecard is like how quickly can you and I have a conversation about what
Mm-hmm.
this family might want to look at doing, and you know virtually nothing about them, right? Other
Yeah.
than a little qualified, I gave you some information, and like you and I as advisors can start looking at like here's the things I'd want to think about.
Yeah, like you didn't give me, before we started recording this, I got no information on this client. I hadn't seen the scorecard. It was, I learned about the client at, real time, so to speak, as the people watching this.
Yeah.
So yeah, it's nice. I can quickly get up to speed, get an idea of, where they're at, next steps, talking points, have great conversations with them, without having to spend hours getting all
Totally.
that information, and going
Totally.
through it, figuring it out. And yeah, I love it. I love it.
That's the thing I love about it, man. Like to me, elements is what we use with all clients first,
Mhm.
and then we go see if we need to use something else.
Yeah.
Like Holistiplan or Wealth.com or Triecto for stock comp or like, Sora Finance for debt. It's like there's all these things we can use underneath it, but we always start with that scorecard.
Yep. Exactly. Exactly. It's just like, we've probably harped on this a lot, but it's just like the vitals at a doctor, right? Like they're going to start there first and then take it whichever route they need to based on those results.
100%. Well, thanks,
So
Colton. I'm glad we got to chat
thanks,
about this
John.
one.
Yeah, this is fun. Thanks, man.
So, what did you think about that? We'd love to hear your thoughts about how we answered that question. Do you think that you would have answered it differently? Comment below and let us know. Now, if you have a scorecard that you want us to dissect or a client question you want answered using elements but aren't sure how, send us the client's one-page plan to cs@getelements.com, and we hope to catch you next time.